There we go.
Hey, everybody.
Hello.
Thank you for joining us. Happy 2026. I am coming to you live from Rhode Island. As always, where in the world are you, Mr. Stoffel?
I am on a coffee farm in Costa Rica. I would love to be showing the coffee farm in the background, but in order to get the internet that's going to allow me to do this, I'm in a little cabin that has access to internet. So you'll just have to take my word for it. You might hear chickens in the background. If you do, don't worry. That's actually quite normal.
Well, you're wearing a
Uh,
T-shirt, so we know that you're not at home.
nope, not in Wisconsin. I got short sleeves on today and shorts. And I
Hello,
see.
Neil, Klaus, John, Susan, Adrienne, everyone that has commented so far. Thank you guys so much for joining us today. Mr. Stoffel, we are back for another stock simplifier, stocks from scratch. And for this week's stock from scratch, what stock are we doing?
We're doing SalesForce. Now this is interesting because Brian, I have been a SaaS investor since 2017. I've never, to the best of my knowledge, I don't think I've ever owned SalesForce. And you were telling me this might be an interesting one for us to look at.
This is a company that I have known about as a public investment for at least 20 years. I remember researching this company, or not researching it, looking at it in 2005 when it was like a $2 billion business. The company I was working for at the time adopted the technology. This is one that the PE ratio at the time was like 180. And I was like, well, can't buy it before I knew anything about valuation, and missed out on like a, I don't know, 40 or 50 bagger at this point. So this is going to be a very fascinating company to research at this point.
And you used it in your job, right? Like that's
Yes.
how you
Oh,
came to it.
I know firsthand how strong these switching costs are for this
Okay.
one. So when the Moat comes up now. If you are familiar with researching stocks, you know that some stocks are easy to research. Some are kind of hard to research. I would classify SalesForce as middle of the road, a little bit on the harder side. They have made a ton of acquisitions over time.
Yeah.
So their financial statements might not be the cleanest out there, but we will, do our best. But we would love to know from people watching, if you could put in the chat on whatever platform you're watching this on, do you own SalesForce? Do you own this company now? Is it on your radar, or are you a current or prospective shareholder of the company? We would love to know that. While we wait for those times to come in, if you're unfamiliar, my name's Brian Feraldi. I've been buying and selling stocks for about 20 years. Here's my performance over the last 13 years or so. It's 13 years because I switched brokers to my current broker in 2012, and I have outperformed my benchmarks, which are the S&P 500, over that time frame.
Yep, and these are my results right here. These I've been investing for longer, but my records go back to 2014, December of 2014. My returns are in the green. The yellow line you see there is the Nasdaq Composite. The red line is the S&P 500. So as you can see, also outperforming there.
Yep. So how do we do this? Why do we win? We are firm believers that we win because we do the research. That research enables us to have conviction. That conviction enables us to develop real patience, and that patience leads to wealth creation. So it all starts. The foundation of this pyramid is knowing how to do the research. So that's the goal for this next hour or so. We're going to show you how we do the research on a stock from scratch using a tool that we created called Stock Simplifier. Now, if you are unfamiliar, the Stock Simplifier is a paid product, and there is a link to do so there. It's a 7-step process to do so, and that's exactly what you're going to see us do over this live stream. Now, we're going to go fairly fast, so this live stream, Stock Simplifier does come with a full course where we explain everything we're doing in detail, along with the slides. You also get the tool that we're going to be using throughout. You also get the AI prompts that we're going to be running to kind of speed up the research process. All of this is included with Stock Simplifier. So do we have any shareholders watching, Stoffel?
We've only got a couple. Carl called out that he was a shareholder. We've got Jeremy, Roman, Karsten, but I would say that by and large, people don't own it.
Okay.
Maybe about 30%.
Okay. Well, while we're waiting for more responses to come in, I'm going to go ahead and open up a fresh copy of Stock Simplifier. I'm going to go ahead and open up a fresh copy of Fiscal.ai, which is our research tool. I'm going to open up a fresh copy of our database of AI tools that we have that are going to use to research this process. And today we'll probably be using Gemini,
Yeah.
to do a whole bunch of this, because that's become kind of one of the favorites with them. So the ticker symbol here is CRM. It looks like it is a $243 billion business, $243 billion. Now, the first thing that we look at with this company is the business growth cycle. Which of the 6 stages of the business growth cycle is SalesForce currently in? We would love if you could put into the chat of whatever product, wherever you're watching this, which of these 6 stages do you think SalesForce is in right now? Phase 1, phase 2, phase 3, phase 4, phase 5, or phase 6?
Yeah, and so Santos says 5. We got another 5 here. RC, Mark, Susan, Roman, a lot of 5s. Got a 4. Yeah, so I would say a mix between 4 and 5s is what our viewers are picking right now.
All right, well, here's our AI prompt database. I'm going to go ahead and make a copy of our full AI analysis prompt. Then I'm going to open up a fresh copy of Gemini. I'm going to paste the prompt in there. And if all is working well, Gemini should say to us, what stock do you want us to analyze? And I'm going to say SalesForce CRM with the ticker. And it should do the analysis and come back with which phase SalesForce it is. Okay, so here's what Gemini says. It's in the phase 5 capital return. And
Can you zoom in just a little bit?
Yep. Better?
There we go. Yep, that's better.
Okay. Why is it in phase 5? Well, it has positive operating income of about 2.2 billion on a GAAP basis. It's growing revenue about 9%. It's got a capital return program, so it's buying back about 4 billion in stock, and it pays out about 395 million in dividends. Now, that means that so that means that we should use the price to earnings ratio and the price to free cash flow ratio. It's a mature business, and we should avoid high growth multiples and forward price to sales. Now, what does this mean for investors? They transition from an aggressive grow at all cost company to one that is highly disciplined and focused on margin expansion and returning capital to shareholders. They have reached significant scale where it's no longer just about customer acquisition, and there are some resources on it. So I would fully agree with that. I'm going to say it's definitely in the capital return phase. This fits very nicely in there. So the reason we do this analysis first is the metrics that we look at and the valuation methods that we should use change depending on which of the 6 phases the company is in. So we think this is a step that many investors skip in their analysis.
It's so important.
It's actually the first one to do. So yeah, there we go. So we think it's in phase 5, and we had AI do that for it. All right. Next step is to take a look at the business. How does this company make money? What are its products and services? Who are its customers? And then we're going to look at some qualitative factors, like how frequently customers buy, can the company raise prices, and more. So I'm going to go to our business analysis prompt, copy that over, put that into Gemini, and we will read the results.
And Brian, this is the one where I think that this is where the AI becomes so helpful, because it is such a smorgasbord, like Slack. I think they acquired Tableau. They've got their legacy Salesforce business. I mean, there's so much. Look at that. It only took like 5 seconds. I'm used to being able to talk more.
Yeah, Gemini is pretty quick. Nice to see. Okay, company overview. What does the company do? SalesForce is the global leader in customer relationship management technology. It provides a cloud-based platform called Customer 360 that unifies a company's sales, service, marketing, and commerce data. More recently, the company has pivoted to an agentic AI model, which it calls Agentforce, and that allows businesses to deploy autonomous AI agents to handle customer tasks and internal workflows. So the company that I was working... Good.
I was going to say, for those that aren't familiar, that Agentforce, those are those commercials you see with Matthew McConaughey and Woody Harrelson. So they're out there talking about it.
There you go. So I used Salesforce.com's technology 20 years ago, and I was in sales at the time. It's how we tracked all of our customer leads. It's how we tracked all of our customer conversions, the funnel that we had, customer shipments were tracked in there, their customer service calls, all of our marketing department, customer support department, and sales department were entirely run on Salesforce. If Salesforce went down, our company's ability to do business went to zero. It was mission critical that the company's that Salesforce was up and running. All right. How does it make money? Salesforce makes the vast majority of its revenue through subscription and support fees. Customers pay to access their cloud software, typically on a per user or consumption basis. Okay.
So now, just one quick thing, real quick. I think it's important to point out that per user basis, I think, is one of the reasons we're going to see why it's down so much, because on a per user basis, you might lose people because AI is running things. I think that's part of the reason.
Potentially. Good color. Okay. So services revenue was about 25% of the total, and this is tools for customer support and field services. Sales revenue is for leads and opportunity management, about 22% of revenue. Platform revenue, which includes Slack and AI development tools, is about 19% of revenue. Data revenue, which is MuleSoft, Tableau, and Data Cloud, those are acquired products, about 16%. Marketing and commerce, about 13%, and professional services, about 6%. This is one-time consulting and training fees. So pretty diversified revenue base.
Oh, yeah.
A bunch of that is through acquisitions, but that's a diversified group. All right. Who are its customers? Company serves 150,000 customers, from small startups to Fortune 500 enterprises. Its clients play virtually every industry, including financial services, healthcare, manufacturing, and the public sector. Where does it operate? 66% of revenue is in the Americas, 23% in Europe, only 11% in Asia Pacific. So 2/3 America, 1/3 outside. That leaves big opportunity outside the US. All right, business dynamics. How frequently do customers buy? Customers typically enter into multi-year contracts, 1 to 3 years, and the software becomes the operating system for a company's sales and support teams, and retention is very high. Again, I can corroborate that firsthand. Salesforce tracks this with remaining performance obligations, which currently sit at $60 billion, representing contracted revenue that will be recognized in the future. $60 billion in RPOs. Can Salesforce raise prices? Yes. In late 2023, Salesforce implemented its first major pricing list increase, 9% increase in 7 years. Its pricing power comes from very high switching costs. Once a company's data and workflows are embedded, moving to a competitor is difficult. The new agent force are also being used as a leverage to increase average revenue per user.
That's good.
Finally, what happens in a recession? Salesforce is relatively recession resistant, but it's not recession proof. Because it's a subscription business, revenue does not disappear overnight in a downturn. However, management knows that tough economic climates, customers may scrutinize budgets, leading to longer sales cycles. Well, let's take a look, shall we, at some actual data from Salesforce.com. So the ticker symbol is CRM.
Now, Brian, while you do that, I just want to point out, I'm getting a message that says that perhaps we've reached our limit on total number of people who can watch this stream, which is weird because we've gone way above thousands in the past. But if you're having trouble viewing this, we're aware of that. We're going to try and fix it after that. And then I also just want to point out, we will be posting this video to our YouTube channel, so you can rewatch it at a later date if you are having trouble.
Thank you. I only see 75%, so I think we're good. Okay. But yeah, okay. All right. Well, revenue, that looks pretty darn smooth and recession-proof to me.
I agree.
Yeah. So very, very smooth revenue growth. In fact, that's about as good as it gets. Let's take a look at some of their key revenues. So sales revenue, service revenue, platform, integration, marketing, and professional services. Yeah, they've got a lot of. All right, let's take a look at. Go to the bar chart in fiscal. By the way, we're in fiscal, and I like doing this because I like seeing how fast each individual one is growing. So green is sales revenue. This is growing 13% per year.
Solid.
Blue is service revenue. This is growing 19% per year.
Great.
Black is platform and other revenue. This is growing 20% per year. Integration revenue is growing 25%. Marketing is growing 24%. And then professional services is growing 17%. So the slowest growth is 13% over at least a 10-year basis. I'm sure if we dialed this into, say, the last, 3 or 4 years, those growth numbers would change. 11, 11, 17, 14, 9, and 4. So every segment looks like it's growing
And
quite nicely.
it's healthy.
Yeah. Diversified revenue over the last 3 years growing about 10%. That is down from the 20%, but still a double-digit range. So, all right. So now that we know kind of all of this, what do you guys think? Is this an attractive business? Red, no, it's unattractive. Yellow, it's good business. Or green, this is a very attractive business. Would love to know what people think about that. But we go with a red, yellow, green system for this.
Yep. And so while people are bringing that in, I'll just give my opinion. Again, the big thing that I think people are worried about is if this is based on seats, then you might, if you just give one AI agent the ability to go in and do all of this, or people build their own things, that could be a problem. But based just on what we're looking at, because we'll get to that in the risks, I agree with what Roman and Santo and Brandon and David and Brenda are saying. This is mostly a green to me. I get where the yellow's coming from, but Brian, I would say that 90% of people give this a green.
I don't even know how you could give it a yellow, to be honest. I mean, the results have been fantastic. It's still growing double digits. It might not be growing as fast as it had in the past, but from purely a look at the business perspective, this is an awesome business.
Yep.
And I think it's very clear that this is a green company. Okay. That was great to see. By the way, if we're using Stock Simplifier to do all this research, if you want access to Stock Simplifier, it's normally $199 if you buy it on the website. Stoffel is going to share a link in the chat on whatever platform you're watching this on to get it for just $99. All of the prompts, all of the course, the tool, absolutely everything is included there. Okay, next section, the Moat. We're going to take a look at this company's moat. Now, there are 5 potential sources of moat. There are 3 current states of the moat: no moat, narrow moat, wide moat. And then there's all important moat direction. Is this a shrinking moat, a stable moat, or a widening moat? So I would love people to guess right at the start, and then I'm going to run the prompt. What do you think, if you had to guess, is the primary moat source that Salesforce.com has? Is it network effect, switching costs, low cost production, intangibles, counter positioning, or nothing? You don't think they have a moat at all? Would love to know what people's guessing is.
So while people are doing that, I think because it is starting to roll in here. I'll give my 2 cents. I think you really hit the nail on the head earlier, where you said if this broke down while you were working for your previous employer, it would have been game over. Everything comes to a screeching halt. So I agree with what pretty much everyone who's responded has said, which is switching costs. Yep, that has to be it.
Well, let's see what AI says. So I just ran the prompt. Gemini says the moat size here is wide, the moat direction is widening, and the primary moat sources are switching costs and network effects. The summary: Salesforce maintains a dominant market position by its embedded platform and has 150,000 enterprises, resulting in high retention and pricing power. The company's Mac as an ecosystem and rapid adoption of Agentforce further solidifies its lead. Okay, switching costs. These are present, they are wide, and they're widening. So the main platform acts as a central system of record for everything, or sales, service, and marketing. Once a company builds this, getting switched is something else. Again, I'll go back to my experience 20 years ago. I can't tell you how many personalized internal reports were generated in Salesforce that were custom to the company. And our management teams, our sales teams were all built on these reports. We were not a big company, but we probably had dozens, if not hundreds. And in fact, we hired someone internally that was a Salesforce expert. Just job was to build custom reports based on the data that was coming in. So getting off of that would be quite onerous.
It's also it's worth just pointing out real quick. I actually researched the history of Salesforce. When they started out, they did have a big churn problem. A bunch of people would sign up and then churn off, mainly because in order to sell people on this, because remember, they were the first SaaS company. Like, this wasn't a thing. You actually had to convince big companies that this was worth doing. And so they get a ton of really small businesses to sign up way back in the day, and they would churn out of it quickly. But as soon as it got to like your experience that you're talking about right now, Brian, they started to move up market and get bigger and bigger and bigger companies. And that's how it led to what they have today.
For sure. Yep. That's a good point. They did start at the lower end of the market and then they moved up market. Yeah. Great point. All right. So this says 92% gross retention annually. That's, I'm guessing, a guess, but maybe that's accurate. Remaining performance obligations is up 12%. And 40% of our agent force new bookings this quarter came from existing customers extending their investment. Okay.
That's great.
Network effects. It says narrow and widening, has a two-sided network effect through its app exchange. As more businesses use Salesforce, more third-party developers like Slack, MuleSoft, and thousands of independent vendors build integrations and apps for it. This makes the platform more valuable for every existing user. 32 trillion records, creates data level network effects where AI becomes more powerful. I'll disagree with that. I mean, yeah, it's a network effect is only comparison to another company's network effect. So I'll say this is a powerful blocker for new entrants, but it's not going to protect them from Microsoft.
Right.
Would be my pushback from there. So that would be my comment, but I'm happy to be proven wrong. Intangibles, narrow and stable. It has
I agree with that.
Brand, very high brand, Salesforce administrators. Putting a lot into R&D, 30% of the Salesforce automation market, and a wide moat due to its substantial intangible assets. I wonder if that's from Morningstar. Low cost production, nope. Counter positioning, nope. It did definitely have counter positioning at the start.
Way back when.
No doubt. So this is a company that benefited from it 20 years ago, but now every company switched to SaaS. So it was there. We have risks with
here we go.
AI.
That's the key part right there that we haven't talked about yet.
Yeah, Microsoft is a major competitor. Oracle is a major competitor, but Morningstar says Moat is wide and it's stable. So I will go ahead and agree with that. I'll say wide, and I'll say it's a wide moat, and it looks pretty darn good to me. All right, next, growth. How is this company going to grow from where it is, and what is its long-term growth potential? A couple ways we figure this out. The easy way is just to go to fiscal and look. So this is a company that's grown about 10% revenue over the last 3 years. Earnings have grown 200% over the last 3 years. So operating leverage is kicking in. But what do I think moving forward? So 10% growth over the next 2 years in revenue. Earnings are estimated to grow about 17% over the long term. So high mid-teens revenue growth. Now, that's what the analysts say, but we have to ask, well, all right, how's that going to happen? Well, what's the magic that makes that happen? Well, there's two ways you can grow. You can get more customers, add new customers, or you can get existing customers that you already have to kind of spend more. So let's do some AI analysis, and we'll do some searching to see which of those growth levers we think Salesforce can pull to achieve that double-digit growth.
Now, Brian, while you do that, I want to set the context again in case people missed it. This, of all companies, I think you would agree, is a company that has grown by acquisition. That doesn't mean that they haven't had organic growth, but if you look over the last 15 years, they have just been vacuuming up companies. And it's been a major criticism because sometimes they pay for that with stock, and they also have very high stock-based compensation, which we'll get to in a minute. The whole reason I bring that up is because it seems like they pivoted. They're not focused on that acquisition at all costs anymore. And so the real
last
question
big acquisition I remember them making was Slack, and that was a few years ago.
4 years ago, maybe.
Maybe they've gotten enough scale, or maybe they're just waiting for their next acquisition. Who knows? It's much easier to make an acquisition when you're trading at 10 times sales than 4 times sales, right? Okay, so let's take a look. So marketing and sales investment, moderate. Sales and marketing means the largest expense, but the company is focused on efficiency. Sales and marketing dropped to 35% as they prioritize profitable growth. So modest decline there. Okay. New distribution channels are moderate. Expansion of App Exchange and Slack. However, no radical new physical or retail channels were added. Market expansion is moderate. Asia Pacific is the smallest but fastest growing region. Overall international growth remains steady, but it's not the primary driver compared to product upsells. That's interesting. I would have thought that would have been a bigger contributor.
Ooh, look at this, a more recent acquisition.
Strong. Company completed the major acquisition of Informatica in 2025 to bolster data cloud, and management expects this to contribute 80 bips to revenue growth. So 80 basis points. So 0.8% of growth. So this says they're not done with acquisitions.
I mean, yeah, we'll see.
Pricing power, strong. They implemented a 6% price increase in 2025 and a 9% increase in 2023. Pricing is a significant lever for organic growth as long as you don't abuse it.
That's a big deal. If you can grow two big price hikes in 3 years and not losing customers, that's a big deal.
Yeah, I would wish they just did 5%, 4%, something like that. That way you don't piss your customers off. Okay, new products and services are strong. AgentForce and the data cloud hit 1.4 billion in ARR, up 114%. AgentForce grew 330%, providing rapid adoption of a new AI offering. And then customer retention, net dollar retention remains high, 92% gross retention. So, Stoffel, what's gross retention mean?
Gross retention means we are not paying attention to all the upsales that might happen. It's just if you had 100 customers at the beginning of the year, you got 92 at the end of the year.
That's lower than I would expect, to be honest.
But it's all those tiny customers. It's like what I was saying at the beginning. They got if you have a startup, you might use HubSpot, you might use Salesforce. I think it's a whole bunch of 1 or 2 people companies that are leaving. I don't think it's the big whales that they have.
And acquisitions and all that kind of stuff also. Yeah, there's multiple reasons to go off there. But I mean, it's still great overall. It's just CrowdStrike is 98%.
Yeah.
Okay. So overall assessment, the biggest growth drivers are going to be new products and services and pricing power. Moderate services are acquisitions and geographic expansion, and then distribution is going to be a low contributor here. So, all right, red, yellow, green. What do you guys think? Does this company have growth potential? Green, its growth potential looks very strong, super exciting. Yellow, it looks good, but not eye-popping. Red, you are worried about the near-term growth of this business. What do people think about that?
I know that. So we see David here says green. Susan says green. Paco and Marks. We have Patrick saying yellow. We've got a whole bunch of. It's pretty much. I'm seeing these roll in. It's a combination of yellow and green. I appreciate someone did green in Spanish there. Yeah, Brian. The way that I think about this, I almost think about this like a sponge. And here's what I mean. Green is pretend water is like what you could collect, and the green is like there's water everywhere. You take a sponge and you're just trying to soak up as much as you possibly can. Yellow is like, okay, I've soaked up a bunch and now I'm going to start trying to wring it out a little bit. And red is like there's no water anywhere. I personally think of this as yellow. That's okay. The way that I think of it, and I think that it did a really good job of showing that where all the greens that we saw in our AI was getting more from their existing customers. So when I say yellow, that's how I'm thinking about it. But some people might look at the exact same things and say green.
I think we're splitting hairs, whether it's green or yellow, but I will go with yellow. I think the growth here is quite good for a company of this size, but it's not spectacular. But the fact that it's still growing and it has a long history of growing, to me, is very positive. This is not a business in distress.
Agreed.
For example. Okay, next, Now we're going to look at some key metrics. Now, the metrics that we look at for a stage 5 business are revenue growth, free cash flow conversion, EBIT to interest expense, return on invested capital, and their capital return program. So this is the one, again, that AI tends to have the most problems with. So we will run it in AI. We will also manually check in fiscal just to double check that everything is working correctly so we can see how well did Gemini do with it. Okay. So first up, revenue growth. It says 13%, which is over our 10% bogey. So this says 10%, which is right on there. So Gemini was a little over aggressive on that, but either way, pretty good.
Not bad
for a company of this size. Next, free cash flow conversion, 162%. What that means is that the company is producing more free cash flow than it does net income. That's fairly common for a software business.
Two things to take into account there. One, they are notorious for having really high stock-based compensation, which is going to make free cash flow better than net income. And two is because they are still growing and they're a SaaS company, you collect all the money at the beginning and you recognize it as revenue, which becomes net income at the end. So that's not surprising.
Yep, it's not surprising to see that, but if you had to choose, it's definitely the one that you want, right?
Yes, absolutely.
Oops, did I turn? I like it.
It's not nighttime, Brian. It's the day.
All right. So I think that is in capital efficiency, or is it in margins? It might be in margins.
Yeah, I think it is in margins.
Free cash flow to net income. Yeah. So this is a company with 178% free cash flow conversion. So they've pretty much always generated, I guess not back here, way more free cash flow than net income. That's a very good sign to see that. Next, EBIT to interest expense. This is a measure of how much debt do they have and can the income statement support the debt. So this says 36.5 times coverage of their.
I think they're okay.
Yeah. So we want this number to be over 5. We want more than 5 times EBIT than your interest expense. This says 36 times. And now in fiscal, that should be, is it EBIT to interest? EBIT to interest. Financial health?
Yeah, it's in financial health.
EBIT to interest expense. Oh, they don't have it listed. Is that because interest expense is 0?
Yeah, I mean, I think that is what it is that they don't, I don't think that they have any long-term debt.
Yeah, this says 2. That says 2. I'm guessing that is mostly a fact that they just don't have any debt, or the debt that they do have is very low cost. Let's do a slightly deeper dive. Short-term debt, none. Long-term debt, 8 billion. All right, let's do the calculation manually. Just go to the income statement, and we're going to look at operating profit, 8 billion. This is roughly a proxy for EBIT, so 8.2 billion. Interest expense, 0.
Yeah.
So, yeah.
It's probably, all that long-term debt is probably senior convertible notes.
At 0%. Yeah. So Gemini says this.
I get why it was confused.
It's green. The result here is the company's interest expense and debt is not a problem at all. Next, return on invested capital. AI typically has a big problem with return on invested capital.
Yeah, it does.
This says 11%. If we go to the overview page, and in the bottom left, it's going to show us the 5-year average. So return on invested capital is 4. But that's the 5-year average. And if a company is not focused on profit, that number is going to be artificially low. So I'm going to click on financials.
I bet it's gone up a bunch in the last 5 years. That would be my guess.
I don't think it's going to be over 20%, but I'm guessing it's going to be up quite a bit.
Up into the right, though.
Ratios. I'm going to go down to capital efficiency and return on invested capital. Yep. So we're right. So 8% return on invested capital. And this is up substantially. So it's improving, but it's not double digit. Yep.
It's all stock-based compensation.
We're going to say less than 10%, but that's more of a mirage than anything else. Finally, capital returns. They've been buying back stock for 3 years. So if it's 3 years, then that should be a yellow. This says 5 years. So if we go and dive in, if we go to the cash flow statement, which is in the financial statements here,
It just decided to stop giving it to us.
It did.
It's not listed now. Yeah, one thing that might be interesting, Brian, while we're looking for that, because I've seen this happen. Sometimes it might not come up. If you go to ratios,
Yep.
and you go to it's whatever the last option is.
Common size?
Common size, yes, common size. If you do stock-based compensation to revenue, you get an idea of what we're talking about here. So it has come down, which is great, but it's still
high.
pretty high.
Yeah,
I mean,
8% of revenue. Well, let's do this. Let's pull up the company's income statement. The cash flow statement isn't working for some reason. And let's go to shares outstanding. And then you can kind of see, okay, so this is shares increasing. This is stock-based compensation and acquisitions. The big jumps are acquisitions. So I'm guessing this is Slack. Yeah. And then they peaked at 898 and now they're not, they peaked at 989. Now they're 952. So the only reason that shares can decline like that is because of buybacks. So they started in 2022, 2023. So they've been doing it for about 3 years.
And that's a lot of money. That means that they're spending more than 8% of their revenue on buybacks, right? If that's what stock-based compensation is and the shares are going down, it has to be more than 8% of revenue.
They need to spend that much, 8% of revenue on buybacks just to break even on the share count. Yeah, essentially. So they are returning capital. They haven't been doing it for that long, but I think that they've gotten religion and they're going for it. So overall, pretty good on the real big numbers. They are returning capital, and just the nature of the GAAP accounting here means return on invested capital is not that high. But this number should continue to increase over time as they do focus on that. All right. So key metrics looked pretty good. Friendly reminder, if you're interested in Stock Simplifier, the tool that we're using for this, it's $99 using the link that Stolf is going to share in the chat. All right. We did key metrics. Oh, I just did all that. Let's do next risk section. So
this is a big one.
Yeah, definitely the big risk. So is this going to be a red, yellow, or a green risk company? Now, we believe that all risk can be boiled down to one risk. Execution risk. What are the odds that the company can't achieve the growth that we need it to achieve to make this investment pay off? So there are 4 major sub risks. There's concentration risk, there's disruption risk, there's outside forces risk, and there's competition risk.
Brian, you want to guess which one do you think is going to be the biggest one that Gemini gives us? I think it's going to be either competition or disruption, personally.
I'm going to say it's going to be disruption risk. Okay, but overall risk assessment here. So Gemini says the overall risk here is very low. It gave a score of 1.25, even though we don't know what that means, but yeah. I'm guessing that's out of 5. The primary risk is disruption and competition. Yeah, that's what I guess. But they have very high switching costs and $60 billion in backlog. Okay, concentration risk, not a problem. 150,000 customers, and no big customer is more than 5% of revenue. Concentration risk, not an issue. Disruption risk. Okay, it says green. While the shift to AI is a risk for many, SalesForce is currently the disruptor.
I'm not sure I totally buy that.
Agentforce platform reached 500 million in ARR within months, and management is aggressively cannibalizing its own human seat-based model with autonomous agents to prevent competitors from doing it first. All right, so this is the innovator's dilemma, and they are jumping whole hog into it.
Well, what I would say is this is a perfect jumping off point for what is the best use for Stock Simplifier? This. So now this thing right here is what I would spend the next week studying if I'm all of a sudden very interested in SalesForce. Is that what they're doing? Are they cannibalizing? And what are they seeing? And go to the primary sources, because to me, that right there is the most important thing that's popped up in this hour that we've got on live.
So if this is going to be disrupting seats and their seat model, what you could expect to happen is that revenue growth is going to slow substantially while AI revenue increases and the traditional revenue decreases. And eventually AI should kind of take over and start to actually provide needle moving growth. But if it could be a reason that this stock is at a 52-week low right now, is that Wall Street sees this happening, predicts meh growth over the next, let's just call it 3 years before this really kicks in. So, okay, that could be very much a reason that the share is trading where it is. Okay, next, outside forces. This says yellow. SalesForce has significant exposure to global economic cycles and foreign currency fluctuations. Management knows that currency volatility is negatively impacted remaining performance obligations. I'm going to disagree. I'm going to call this not an issue at all.
Tell me why.
I don't view currency issues as a major outside force. Only a third of this company's revenue is from in different currencies. So maybe it might tinge growth by a few percent, but I don't view that as a major outside force. I view a major outside force, commodity prices impacting revenue, oil prices impacting revenue. You need a strong economy. There's some interest rates are outside of your control. I would view this as a non-risk personally.
Yep, I agree.
Competition risk. This says green. Okay, despite intense competition from Microsoft and Oracle and SAP, Salesforce remains the dominant leader with 22% market share and gross margins of almost 80%. So it's not yet succumbing to severe pricing pressure.
That is the most important thing to watch, are those gross margins. Now, there might be some explanation for why they might contract. As we said, that transition from seat-based to agentic-based, there might be a period where that gross margin does need to contract, but over the long run, if that isn't going up and to the right, or at least staying stable, that's the red flashing sell button light.
So overall here, no low concentration risk, low disruption risk as of right now. Whether you agree with not is up for debate. I would say low outside forces risk and low competition risk. So let us know if you're watching. Red, yellow, green. What do you think is the risk profile of Salesforce.com, the business? Red, high risk. Yellow, medium risk. Green, very low risk. And while we're waiting for those to come in, let's take a look at the gross margin of this business.
Yeah.
And I'm going to assume that it's bounced around quite a bit based on acquisitions.
Yeah, and that's the part where it's so important to understand all the moving pieces.
Well, it definitely has bounced around 75 to 73 to 77, but I mean, look at the last 3 years.
Solid. Yeah.
Look at the last 3 years. Gross margin has expanded. For those that are unfamiliar, what this means, for every dollar in sales, how many pennies become gross profit? It used to be 73 pennies. Now it's 78 pennies. That might sound small, but that's 6 extra pennies per dollar in sales in pure gross profit generated. So I view this as a excellent development. And I wonder if that can continue. Normally, when a company goes with a platform shift, the gross margin suffers in the short term.
Yeah, significantly.
So I'm guessing that this number is going to decline or at least tail off as Agent Force kind of grows. But I don't know. I'm making that up. But what if people think about the risk profile here?
By and large, green. Now, let me just say, if I was filling out Stock Simplifier, I would give it a yellow, but I just want to explain why. Because this would be the other thing that I would force myself to go back and research to see what the trends are, what management had to say about why they're changing, and what kind of forecasts there were moving forward. Based on the data, I think it's a green, but I would put a yellow because I know that would get me to go back.
Fair enough. I'm going to call this green. I'm going to say it's a low risk. As far as businesses go, this to me is definitely in the low risk category. All right, up next, valuation. Now, because we know this is a phase 5 capital return company, there are 2 metrics that we should look at: price to earnings and price to free cash flow on a trailing basis, looking backwards, because it is in the capital return phase and it should be optimized for earnings. So that's in the ratios section. And then we're going to be looking at the trailing, which is the top number. So we're looking at the price to earnings ratio here. So look at all this time period here when it was not in phase 5, this useless, utterly useless to us. It only entered phase 5 in 2020, let's just call it 2023. Yep. So useless, useless, useless. It gets useful around here, September of
Yeah, you could pull
2024.
it forward even more.
I'll go quarterly to get kind of a more nuanced view. Nuanced
Wherever
view.
that,
So yeah, it's really around
September
here
23.
that it became.
Yeah.
And go forward a
One
little bit.
more. There you go.
All right,
That's
there we
good.
go. Semi-useful. Okay.
I can't see that number. What is it? 35?
34.
34.
34 times trailing earnings. 34 times trailing earnings. All right, that's price to earnings. But remember, this company produces more free cash flow than it does earnings. So if you look at price to free cash flow on a trailing basis, yeah, that number might be even better. Even better. I wonder if we can go backwards further.
You probably can.
Yep. Okay, so this was as high as, call it 52 times free cash flow, currently 19 times free cash flow. And if we take the median and the high and the low on this by turning on those toggles, 16 times free cash flow was the low back in November, currently about 19 times trailing free cash flow, an average of 27 times free cash flow. And even if we kind of take this to the same time frame, the average over the last, call it 2 years, is 25 times free cash flow, currently 19 times free cash flow. So, all right, red, yellow, green. What do you guys think of the valuation of SalesForce today? Red, overvalued; yellow, fairly valued; green, undervalued. And while we wait for those to come in, I'm also going to take a look at the forward numbers because this is still a growing company. And while Stock Simplifier says trailing earnings is probably best, I'm going to argue that forward earnings is probably the best number to use here.
Well, there's nothing wrong with peeking at it.
No, exactly. So if you look at the forward number here, 21 times forward earnings. Forward earnings, 21 times forward earnings.
They are increasing their profitability very fast for a quote unquote stage 5 company.
Yep, definitely. Yeah, or at least they have in the past. And if you look at price to forward, price to free cash flow. So this is free cash flow based on next year's earnings estimates, 16 times forward free cash flow, got down as low as 14 times free cash flow. And Brian, if you want to do even one more metric, I like using free cash flow yield as a metric. Free cash flow yield, which is basically like, free cash flow yield. So this is a company that's yielding, its stock is yielding 5.2%. So here, higher means cheaper, lower means more expensive. So this is a company with a 5% free cash flow yield. If you are measuring it, think about like that the interest rate that you're earning on the stock from a free cash flow perspective, 5%. So if they paid out all of their free cash flow as a dividend, you'd be getting a 5.2% dividend yield on the stock right now. So
Santo brings up a nice question real quick. What would its rule of 40 be? I guess maybe before we do that, I will say it was a mix between green and yellow. By and large, it was probably 50-50 split.
Yeah, I'm going to say a yellow on price to earnings, green on price to free cash flow would be roughly where it is. So the rule of 40 depends on how you calculate rule of 40, of course. But if we did revenue growth rate, actually, I made a custom metric one time. I think, let's see if it still pulls up. With fiscal, you can do, there it is.
Hey, look at that.
I did do a rule of 40 as a custom metric. So the rule of 40 here is 30. So this is revenue growth plus, I think it's free cash flow growth.
I imagine it would have to be if it's a really good number for
what did I do?
SalesForce.
Okay,
I
did free cash flow. I did free cash flow margin plus 1 year revenue growth. So can
you pull up the trailing 12-month view instead of the quarterly? Because you see it spikes a whole bunch.
Oh yeah,
probably at the beginning of the year when a bunch of that free cash flow comes in.
Oh, there you go. Yeah, that's better. So let's make this go. So this is a company with a 40 rule of 40
Right on 40.
growth. So if you're a rule of 40 fan, this company is right there, which again, for a mature business is very hard to achieve. So it's certainly right there. So I'm going to say a green on that. Okay. So doing pretty good so far. I've got to go skip forward through a bunch of these things here. We do. All right. Now we're going to do one more prompt. This is going to be a sentiment prompt. So we're going to do some analysis of, okay, why is this company trading cheap?
So cheap.
You can run this prompt to be like, okay, go out, analyze why, what is the market's sentiment on this stock right now? Okay. So SalesForce struggled due to fears of SaaS displacement by AI, but rebounded following the explosive launch of Agentforce and a 6% price hike. While it significantly underperformed the S&P for the full year, strong earnings and record AI contract wins have stabilized the price for. Next catalyst is its earnings release in March of 2026, and the key focus will be on Agentforce ARR.
It gives us the outlook. That's great. So
analysts are bullish, investors are neutral, the media is positive. What the bulls say. Bulls argue Salesforce is no longer a slow growth CRM, but a leader in agentic AI. And it's an undervalued blue chip with a capital return program. What do the bears say? Decelerating sales in its core business suggests the market is maturing and making double-digit revenue growth harder. Microsoft is gaining ground, and the pivot to Agentforce might cannibalize existing seat-based revenue at a faster rate than it adds new consumption revenue. So that is, and then here's some kind of links to it. So that is what the sentiment analysis is on the company right now. So those fears that you kind of highlighted before are what is being echoed by the sentiment out there. That's why that prompt is pretty cool. Okay, taking it all into account, we have determined that this is a phase 5 business. It's got a great business, a wide and stable moat, good, solid long-term potential. It's got mixed results on the key metrics, although I would argue overall pretty darn good. It's a low-risk business trading at a moderate to great valuation, and its sentiment is currently depressed, hinging on that AI issue. Red, yellow, green. Is this a stock that, hell no, get it off my radar? I'm kind of interested in, put it on my watch list. Or green, I'm interested in buying this stock today. What are people are saying?
We got a red and a green so far. Someone else asked, Carl asked, what is the rule of 40? It's just measuring revenue growth plus some type of profitability metric, and you want it to be 40 or above. I would say that we are getting we're getting greenish yellow is what we're getting. Brian, I'll say this. It was about a month ago that we did Adobe, I think. And after we were done with Adobe, I purchased shares of Adobe. So it's like a 4% position for me. This is in that same category as Adobe for me, like blue chip-ish stock that I'm very interested in. And I'm sitting on a 30% cash position. So I'm going to spend some time researching this. Doesn't mean I'm going to buy it, but I'm going to spend some time researching it.
Yep. James asks, would you ever look at a technical chart to pinpoint when you wanted to get in? That is something that I personally do not do on a consistent basis, but I see no reason not to look at it on a technical basis if you want to kind of get in and figure that out. Stoffel, you use technical analysis a little bit.
Yeah, so what I would do with this is, let's say I spend the next week researching this and I like it. And I say, you know what, I've got 30% cash, so I'll throw a certain percent in without worrying about the technicals. Where I would look at the technicals is when I might add to it. So in this case, I would look at it, see where it is in the 200-day moving average. And if it gets above that and bounces off of it and the 200-day moving average starts moving up, I would feel okay adding and making it even larger.
There you go. Awesome. Well, I hope that was useful. We kind of got the big gist for this company. I do not own it, but I think it's a pretty compelling time to jump in to this business. I think it's low risk. I think it checks a heck of a lot of boxes for me. And the fact that the company got religion on capital return programs, and it clearly has the capital to do that, I think is pretty darn compelling. Friendly reminder for everybody, if you're interested in Stock Simplifier, which is the tool we use to research everything, and it comes with the full course. If you're like, what does that term mean? Because we do go pretty fast for this. There's a full course that goes along with it. You get the tool that we have and the checklist that goes along with it. You get all the prompts that we just used. $99 if you use the link that Stoffel is going to share in it. Well, thank you guys so much for joining us today. We hope that this was useful and educational. I certainly learned about SalesForce. I think it's a very compelling stock today. But we're always looking for ideas. What stock do you want us to research next? Throw it in the chat. We keep track of stocks that interest people that you want us to take through this process. So if there's a stock out there that interests you, we will add it to our newsletter, and our newsletter comes out tomorrow morning at 5 a.m. And there's going to be 4 stocks in there for you guys to pick from for what stock we're going to be doing next list. But if you have ideas for us that you want us to use in future deep dives, please let us know. We are always looking for ideas. Oh, Sprouts. I think SFM is Sprouts. Is that Sprouts?
Sprouts Farmers Market. Yes, which believe it or not has been a pretty incredible stock to watch over the last couple of years. Duolingo.
Oh, Reddit's an interesting one. Yep.
Yeah.
I don't know. SPG, is that Simon Property Group?
I don't know.
Netflix. Did we do Netflix? Yes. No.
I think, I'm not sure. I'm not 100% sure.
Anyway, I'll add Zscaler is a very interesting one. HIMS we have put on the voting list multiple times, and it just is never.
It's close. It never gets there though.
Oh, Doug, it says ServiceNow. That would be a good one to do. SoFi
down a bunch.
Yeah,
ServiceNow is down a bunch too recently, and SoFi for whatever reason is down like 10% today. It's not a company I completely understand either.
Brandon says the missing part of Stock Simplifier is the bounce board of these presentations. Do you know what that means?
I'm not, but we're working on a
I don't know what you mean by a bounce board.
Well, send us an email, Brandon.
Yeah.
Brian at longtermmindset.co. Send us an email, and we would love to hear about it because we're always looking to improve it.
Absolutely. We take feedback extremely seriously, and we are very open to ideas to make it to better. It means chatting. Oh, so like a community? A community section to it. If that's what you mean. Oh, Portillo's. That's a good one. Zoetis. Yeah. Great. Anyway, please email us or put in the whatever platform you're looking at ideas for stocks to do. We are happy to take a look at them in the future. We will be back next Tuesday, same time, same place, Tuesday at 12 o'clock with another deep dive. And we will announce to our email subscribers on Friday which stock wins tomorrow's voting. So thank you guys so much for spending an hour with us. We hope this was educational, and we look forward to seeing you next Tuesday and pretty much every Tuesday at 12 o'clock throughout 2026. We do hope that you guys join us. So thanks for watching, and we'll see you next week. Bye.